Alrighty, how is everyone? Okay, so let's go ahead and get started. Today's date is the 11th of February 2026, and this is another weekly lecture. Now, always just remember everything that we talk about is intended to be educational in nature. We don't try to give any advice, and if any advice is given, it's just general, okay? So it's just like, what are we doing? How are we doing this? And it's not ever intended to give you, financial advice. So it's intended to give you advice on how strategies are applied and used for the purpose of doing any sort of Gann analysis or Gann trading. So just keep that in mind that you'll always be in charge of your own decision. Now, I thought that today, because I am actually away for a little while, this lesson would be mostly based around the truth of the stock tape. And I wanted to spend maybe the next 1 or 2 weeks just going over this, and we might be doing slightly shorter videos, not the full hour, depending on time, of course. But the whole purpose is that we're going to be taking a look at one of Gann's concepts, which is the 3-day rule, or the rule of 3. So what I mean by 3-day rule, the rule of 3, well, basically, if we look at it from a day trading perspective, generally speaking, we will be dealing with a daily chart, and therefore we have to deal with a 3-day movement. However, there's going to be so many examples I'm going to show you, especially in this lecture, that it's not just 3 days. It's really the rule of 3, and 3 is just a guide. Okay, so it can be 2.5, it can be 4, but 3 is really a guide here. But what Gann had found out, or what he told us, and he'd obviously gotten this idea or this concept from the Bible and whatnot, was that the markets move in 3s. And I'll like I said, show you the variances or the nuances of this strategy. But if we were to just average it, 3. Okay, so just remember 3. 3 is important. Now, I want you to think 3 days, 3 weeks, 3 months, 3 years. Starting to get it? What about if we go down a tier? Okay, what if we're looking at a daily chart? Well, then it'll be 30 minutes, 3 hours. You might break up the day in half and you might do a portion of 3 for that. Doesn't really matter. The whole point is that the key here is the number 3 or variations of the number 3. So as always, we will go into this. Now, I don't want to bore you in the sense that I don't want to just be here reading out to you. That's not the idea today. I'm actually going to hand over to one of the instructors, which is an AI-generated instructor that we use at the School of Forecasting, and we call her Luna, and her job is to really go over the content in a way that really simplifies it. Now, the idea is that we'll spend generally 20 to 30 minutes on theory stuff, but I really wanted to go down and just show you, to be honest, most people don't even read the books that Gann gave us, and they just try to look on YouTube and they try to, look on the internet for shortcuts. But if you actually go into Gann, and this might not happen the very first time you pick up Gann, but if you go into it and you read it over time, you'll start to realize that a lot of the stuff that he was telling us does actually ring true. Now, I'm just trying to get down to page 79 here because I've just highlighted a section for you, and that's the section that I wanted to show you. And it is in this chapter that we're in here. Okay, here it is. So in this chapter, he says, the advance, which amounted to 55 points, lasted a little over 4 months, during which time the weekly chart shows that the trend never changed. So basically, he's talking about a sideways trend. But during this time, if you will go back over the tape, you'll find dozens of times where you could have sold out and gone short and lost money. Why? Because a move that would run 30 minutes, 3 hours, 3 days down would fool you and make you think that the trend had changed. Again, he's telling us that even in sideways trends, bullish trends, downward trends, etc., we should always be looking out for this rule of 3. And you're going to see it on a sideways market primarily. So let's just say you have a sideways trend. I'll go ahead and draw it in for you just so that's all visual. So we have the sideways market, right? So the market's come either down or up into it. It's come out, made a high, made a low, etc. And then it's moving up, and there's no real defined time frame here. But let's just say that it spent the next 3 bars, whatever time frame it is on, moving down, and then it travels up again. Okay? And then what happens is it might break it, might come down, and this time it's going to break it lower and then travel up 1, 2, 3, and then break it lower. Of course, this is just a hypothetical situation, but inside this trend, we're going to see that the market is going to make these 3 days, 3 weeks, 3 months, or even 30-minute movements in the opposite direction. I think that's something that we can really use. So sit tight. I'm going to hand over to Luna. Luna is not going to show you anything on screen, so it's going to be an opportunity for you to listen and absorb the material that Gann was giving us. And I'll come back and touch base with you straight after that.
Hi, I'm Luna. Today we are reviewing the specific timing observations found in W.D. Gann's Truth of the Stock Tape. We refer to this as the Rule of Three. It is a consistent metric Gann used to measure the duration of market moves. We are not discussing forecasting theory here. We are looking at the hard constraints of duration. We will examine how this rule applies to daily reactions, weekly cycles, and broader market phases. We begin in Book 1, Chapter 3, where Gann establishes the distinction between minor fluctuations and the time required for major trends. He writes, "Expert tape readers are very few and far between. It is a study of a lifetime. While the tape shows the trend of the market, there are so many minor changes and quick reversals that the average man cannot tell whether the big trend has turned or whether it is only a minor change that will last a few hours, a few days, or a few weeks before the main trend is resumed again." Gann continues, "Market movements of importance, i.e. the long swings, require weeks and sometimes months to get ready or for accumulation and distribution to be completed. There is always plenty of time to buy or sell 1 or 2 days after a big move gets underway. Therefore, it is not necessary to watch the tape every day or every hour in order to determine what stocks are going to do. It requires time to buy a large amount of stock when accumulation is taking place, and it requires time to distribute a large amount of stock at the top. 1 day, 1 week, or 1 month is not enough for a big move. Sometimes it requires several months or even a year to complete accumulation or distribution." Now, once we understand that macro time frame, we can look at how liquidity actually enters the market during the trading week. In Chapter 4, Gann identifies a specific cycle of volatility that occurs on Monday and Tuesday as professionals position themselves against public orders. He explains it this way. As a rule, out-of-town buying orders accumulate overnight. If the buying orders are in excess of the selling, stocks will advance for the first 30 minutes while the public's buying orders are being filled. Then a reaction will take place. Prices may go lower than they were at the opening, drift along in an uncertain way until about 2:30 p.m. when the professional crowd on the floor decide to even up, then either advance or decline for 30 minutes. The newspapers on Sundays usually carry a review of the market for the past week, and the public send in their buying and selling orders for Monday morning. If the orders are very heavy, they will influence the market for 30 minutes and sometimes 1 hour. After this, the trend of the market will be the opposite. Even if it is a bull market and going higher, you will be able to buy cheaper on Monday afternoon or Tuesday when the professionals are hammering prices down after the public buying wave has been satisfied. This initial volatility often resolves into a very specific 3-day pattern. Later in that same chapter, Gann observes that selling pressure tends to exhaust itself by the 3rd day as the weak hands liquidate their positions, creating a predictable pivot point. He states, "The first day of a decline, no one worries much because they consider it a natural reaction. A market will often start declining on Wednesday. On Thursday, the decline continues, and the traders begin to sit up and take notice and think they had better get out on the next rally. But Friday comes and no rally. Instead, stocks get weaker. Why? Because people who wouldn't sell on the first or second day of the decline begin to sell on the 3rd day, and by Saturday, the whole crowd gets scared and decides to get out and not go over Sunday. This same rule applies to declines and advances lasting weeks or months. The longer the market goes one way or the other, the greater the buying or selling in the last stage, because hope or fear increases. This 3-unit duration isn't just for short-term panics, it scales up to the broader market structure. In Book 2, Chapter 11, Gann categorizes the maturity of a campaign into zones, noting that specific phases of distribution often persist for 3 months or more. He writes, The first zone above normal marks the period of quiet advancing prices, which attracts very little attention. This zone may last 1 month, 3 months, 6 months, or a year, depending on the cycle the market is passing through in general conditions, because from normal to the third zone at one time may be reached in 12 months, and at another time may not be reached for 5 or 10 years. The third zone, or highest above normal, marks a period of distribution. Weeks and months go by and stocks continue to advance. Reactions are very small. In this stage, for weeks and months, every few days stocks will open up anywhere from 1 to 5 points higher and keep on going up without much reaction. However, within these active zones, we need an execution rule. In Chapter 12, Gann provides a strict binary for the professional trader. He states that in a strong trend, a reaction is valid only for 2 days. If the market fails to resume the trend on the third day, the environment has changed. His rule is, the way to tell when to buy or sell after stocks are away from extreme tops or bottoms is to watch reactions and rallies. Watch the time required to complete major or minor moves. In very active markets, stocks will seldom react more than 2 days, or the third day they will sell higher. Buy on the second day's reaction and stop 3 points. After a stock has held below a top or bottom for 2 weeks or more, gets active and makes a new high or low, then buy or sell as soon as it gets active in new territory. As a rule, when accumulation or distribution is finished and the move is underway, you can make more money in 1 to 2 months' time while the run is on than you can trading for the narrow swings in 6 months' time. Finally, we apply this count to the overall trend structure. Markets do not move in a straight line, they advance in sections. In the closing pages of Chapter 12, Gann identifies that these movements typically occur in a sequence of 3 to 4 waves. He notes, bull or bear markets all move in sections of 3 to 4 waves up or down, individual stocks working out their high or low points according to their time factor and individual vibrations. A pool may form in the early part of the year, the advance comes in April or May, a break occurs in June or July. This may go on for 3 to 4 different times. I'll now hand you back to Jonathan, who will show you how this applies in the current stock and cryptocurrency markets.
Alrighty, so now that you got a little bit of an idea, now we're going to just do another summary again, just to make sure that there is definitely no misunderstanding here. I just want you to know that throughout Gann's books, actually throughout multiple of his books, he did often talk about this rule. And we're talking specifically right now about the rule of 3 written in The Truth of the Stock Tape. Now, this is one of his first books that he published. So this goes way back, back to the 1920s period. We're going to take a look at this chapter. I'm going to read it out to you, okay? So listen along. Before you start trading in any stock, get a chart on it for several years back if you can. Study it closely. Note the level at which bottoms and tops have been made. Find out where its previous resistance points have been made. Then you'll be able to determine whether you are entering the market at a safe or dangerous level. Suppose in 1921 you wished to buy a railroad stock which paid a good dividend and had prospects of advancement. We will presume that you made up a chart on New York Central from 1896 to date. See chart number 5, and he gives it to us. We won't go for that though. Now read about New York Central under chapter How to Tell the Stocks that are in a strong position. Thus you will see that by having a record of stocks, you get acquainted with their movements and are able to know whether you are buying near the top or bottom of a move. What he's basically trying to say is keep a chart. And this is something obviously fundamental analysts maybe not be looking at as particular. So Gann was very big on the technical side of things. But let's go, because there is a little golden nugget in here. I just want to show you where he slips them in. Suppose you make up a chart of a stock and find that it has advanced from $10 a share to $50 and is selling at 40. So it's gone from 10 to 50 and now it's at 40. This would not be a safe place to buy because it is too close to a high price and too far from the low. Of course, this does not mean that many stocks which have reacted from 50 to 40 are not good purchases. I am merely giving you an example of a place of safety in buying or selling. No matter whether it is a small move or a large move, before you buy or sell, you should wait until the stock shows that it is meeting with resistance one way or another. Always remember that you should have a reason for making a trade. Do not buy or sell or hope. This is pure gambling, and gamblers always lose sooner or later. He continues, when to buy or sell after extreme tops and bottoms. The way to tell when to buy or sell after stocks are away from extreme tops or bottoms is to watch reactions and rallies. The average stock reacts 5 to 7 points, sometimes 10. Low price stocks 2 to 3 points. Watch the time required to complete major or minor moves. In a very active market, stocks will seldom react more than 2 days, or the third day they will sell higher. Okay, buy on the second day's reaction and stop 3 points. If stock gets dull or narrow near the bottom or top, wait for activity, then buy or sell. After a stock has held below a top or bottom for 2 weeks or more, gets active and makes a new high or low, then buy or sell as soon as it gets active in a new territory. Now, in this case, what he's saying, and we'll just do a little doodling. Okay. So the first one here is he's saying, in very active markets, stocks will sell and react more than 2 days, or the third day they will be selling higher. So the market's coming up, okay, it's coming up, and then it goes down, down, and then generally the third day we get that reversal. Okay, so we have our closes here, and on the third day we get the reversal. Now this is all good in theory, but we have to make sure that it works in real life, and that's why we really want to go to the charts and just really formulate the plan that we would be using for this, okay? And if you've been around for any specific amount of time, you are probably familiar with this or you've seen it. Perhaps you've never seen Gann's own words on this before, and also perhaps you may just need a refresher for it to click. So we're going to go over it, and that's the whole point of today. Now, if stocks get dull or narrow near bottom or top, wait for activity, then buy or sell. So basically, market comes up, and then it kind of gets dull, and he's saying wait for the activity to increase. Okay, and then generally you would be wanting to buy once we get that activity. After a stock is held below a top or bottom for 2 weeks or more, gets active and makes a new high or low, then buy or sell as soon as it gets into new territory. So count the period. So basically, we've got our same line, the market's come up, and then it's come down and it's done its thing. This is week 1, this is week 2, this is week 3, and then it starts to go do. So basically, we're going to get our range as the market moves up, and he's basically telling us to count for three weeks. So if we're doing small time frames, it might be 3 days. If we're doing 3 weeks, and if it's a long-term stock, it might be 3 months. And if it's even longer than that, like it's just doing nothing and it's stuck in a range for a long time, it might be 3 years. But we need to wait that time period and then wait for it to get active. Once it breaks its direction, either higher or lower, then we trade in that direction. But he's basically saying that there's going to come times where the market's going to go dull, and we need to be aware of that. Okay, so we're going to switch over now to some charts. And what I'll do with my charts, all of them, so this is Optima. I right-click, I go to the pencil, and I click Swing Relations for Color Scheme. This is just the way that I was taught to read the market. Most people read one color. Most people read 2 colors, so the bar strength is, well, generally 2 colors would be strength like this, so black and red, or green and red, or something like that. While others are going to be doing what I do, and that is tracking the inside bar, the outside bar, the up bar, and the down bar, and that is what we call swing relations. And this has got to do with Gann's swing theory. Okay, so we look at the chart because we can overlay Gann's swing theory. Now, that's just why I set my chart up like that, okay? The second thing that we do is we have line width 2. If you do it any thicker, 3 is good as well, depends how far away. But if you do like 5 and then you zoom out, it starts to get really hard to see. So when I'm zooming out, I like to decrease the size, and generally 2 to 3 is where I sit. So it's a lot easier to see as we zoom in, a lot easier on the eyes. Okay. The next thing you'd want to be doing is checking the daily, weekly, and monthly charts. And we're going to be doing all these 4. Okay, so the XAU, which is Australian, Dow Jones, which is the American, Bitcoin, which is a cryptocurrency, and XAU USD, which is gold. Now, what we're going to be looking at is for reactions that last in groups of 3. Now, if the very first rule, okay, so if you really want to be using this, the very first thing to be doing is putting on a moving average. If you don't have any way or skill or understanding of which way the market is going. You want to have a moving average on there. And you don't want to have it too volatile. You kind of want to do a 20 period moving average. I'll just change that to black. But really, we want to make sure that we are looking at or understanding the direction of the overall trend. Okay, that is very important. So as the market moves, for example, this period here with a trend where the price is above the trend, okay, that's really clear as well. And then really we want to be counting, as Gann would tell us, the 3-bar rule. Okay, the thing that we need to be watching out for is that it's daily, weekly, monthly, and yearly. Now, each of them moves in line with the other. What I mean by that is if we've passed the 3 to 5 day rule and the market then continues to fall for, say, 7 to 10 days, then we are crossing the territory of moving into the 3rd week, the 3-week rule. If we then say that we're looking at the 3-week rule and then we see that the market's actually falling for 4 weeks or 5 weeks, 6 weeks, then we would be looking at the 3-month rule. Does that make sense? So as time goes on, and because markets are living and breathing, we will definitely see it in the action. So what I mean by that is, if I get a little pencil here, we can see that in this case, the market is trending up. We have that price action along with the moving average trending up. Here we actually have the trend or the moving average flowing down. It's coming up again, but price is still below it. Price is now below it, I should say. So in this case, we'd probably be looking for the 3-week or the 3-month rule to be active before we make any decision. Now, again, this is all relative. This is only one method. Again, doesn't say buy on the 3rd day. We want to be buying into strength or buying into support and selling into resistance and things like that. But we are clearly just looking at one model. So now you've got some of the theory out of the way. You understand what Gann was saying. You've got the textbooks, comments, things like that. Let's take a look and see if we can get this working at all. I'm going to try to, if I can, duplicate this chart. Okay, because on one side we want the daily, on the other side we want the weekly. Just going to link these up. That way when I roll over with my little mousey mouse, yellow, okay, we can sync them up. Now, I'll just turn position and data value off. Now what we want to do is find a time period to be researching. I think that we take from the 2023 low out to 2026 and do this period. So the 2023 low out to 2026. Okay, so we're going to start back here. Now we can see that the market is in a uptrend now. Okay, the moving average has pointed higher. We have price above the moving average. Now, if we follow Gann would generally say that reactions would generally last 2 to 3 days. And if they last any longer than that, we're probably looking for the 7 to 10 days. But we want to be really getting in as soon as we can towards the lows of these moves. So 15th, from the 9th to the 15th of November, we have this reaction in here. Okay. And we can see that the market topped out, moved down 1 day, moved down 2 days, and Gann would tell us that we would be looking to buy on the 3rd day. Okay, that's pretty nice. This one, the market moved up, it moved down 1 day, moved down 2 days, and we'd be looking to buy on the 3rd day. I know what you're thinking right now. You're thinking, oh wait, but it continued to advance lower. And yes, it did. And we can also take a look at these swings from another perspective. The market was falling, it rose for 1 day, it rose for 2 days, and then on the 3rd day, it fell. Okay, so it rose for 1 day, rose for 2 days, and on the 3rd day, it began to roll over. Okay, so then we come here and we go 1, 2, 3. We can see this congestion. Gann would say we'd be looking here. And I generally say 3 to 5 days is the sweet spot. And then if we get any past that, then we're looking at the weekly chart. So let's take a look at this January period. January, okay, in here. So this is quite a sustained downtrend. And a lot of people would be looking at this, and the bit I'm talking about is right here, okay? This is January 2024 out to 18th. And we can see that over here we have January 2024. That's this period right here, okay? Now, I want you to think, if you're following the daily chart, you're going to miss this completely. And that's why we use a wheel within a wheel, or basically a time frame overlapping another time frame. Okay, so we got our daily chart and then we got our weekly chart. So the daily chart runs down 1, 2, 3, 4 days, and generally the 5th day will advance higher. It did do that. But then if we block this out, I should say, then it collapsed lower. So from here it ran down 1, 2, 3, 4, 5, 6, 7, 8 days. Okay, so now that's it within the 7 to 10 days. Now overall, it went down 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days from the first reaction down to the bottom. Now, if we want to smooth all this out and we want to get an understanding of where we should be looking to buy, we would be looking at the weekly chart. Okay, and at this point, we would take this one, we would do 1 week, 2 weeks, and on the 3rd week, we'd be looking to buy. That really smooths out a lot of the drama that's happening on the daily chart. And a lot of this price action to the sideways move, okay, really starts to make sense now. Again, told us, again, you might recall, he said that when we're in a sideways market, the market's going to come up, and I showed you an example at the very start, and then it's going to react for 3 days. So a lot of people are going to be buying in here, and then it falls 1, 2, 3. Okay, does it often. 1, 2, 3. This one is 1, 2. On the 3rd day it rose. If you want to count from the very top, it would be 5 days, but the red days I'm just counting here. So 1, 2, 3. 1, 2, 3, and you'd be buying on the 3rd day. We get this portion in here. Okay, I'm going to confuse you now because I'm going to be overlaying different concepts, but I'm just trying to show you with the data I've got in front of me how all these concepts are sort of coming together. And then you can take this to the market and you can try to backtest it yourself and get an understanding. He also said that when price is trading sideways, okay, so we're in a range here, he said that once price has traded sideways for, say, 3 days, 3 weeks, 3 months, etc., then we would be buying once we get activity where we're breaking the tops. Okay, we would be buying on the 3rd, or basically we're buying on the break. I shouldn't be counting there for you, but if we were to go over here, so this is February 2nd to February 28th. This is February 2nd to February 28th. That's this period in here. And what do we see? Well, we see the price on a daily chart go sideways and sort of get stuck in a range, or if you really want to be fancy, you could draw some sort of pattern in there. And then if we just look at the weekly chart, we just see 1, 2, 3, and then we have our break. All we're doing is counting to 3. That's all we want to wait for. Okay, so we move forward in time. We see that the market fell 1, 2, 3, 4, 5 days. Okay, so it's within that 3 to 5 day range, which is what I pointed out to you. And then once we get the reversal, we get these strong bars up, you would count 3 days to make sure there's not going to be any inter-trend reversal. Okay, so 3 days up, 3 days down. Once it passes the 3 days and you start to get these breakouts or change of structures or whatnot, you might decide to then trade that. It depends on really your risk tolerance and what you're looking to do. If you're really ballsy, you might trade down here. You might open up on the advance, stop below the lows. Or if you're not so ballsy, you might wait for the break and then maybe have your stops higher up. It really depends on each individual. On the weekly time frame, we have 1 bar down, 2 bar down. The 3rd bar is the break. Okay, that's interesting. Now we go to this weekly time frame here, where we had this really long or prolonged sideways market movement, and that is this point in here. Okay, so the market really just traded sideways for this time. I'm going to get a time measure just to make this process a little bit easy. We're going to start from the first bar after the top. Generally, it would start from the first bar after the top. I'm going to pull it out until the bar before the break. I'm going to change that. For calendar days, we know that's 99 calendar days. For trading days, that's 69 trading days. For weeks, that's 14 weeks. And for months, that's 3 months. So you can see here that as soon as we progress or past the 3-day rule, we transition into the 3-week rule. And after we transition into the 3-week rule, we then transition into the 3-month rule. The same thing would go for the 3-year rule. I don't know if I get a chance to show you that, but once we progress past the 3-month rule, then we would be on the lookout for something lasting as long as 3 years. Of course, every market's different. Not everything gets stuck in a trend for 3 years. But long trends that have been going sideways for a very long time tend to or can culminate at the end of the 3-year period. Okay, so we've got our breakout, not a problem at all. So the market's come up. It's then given us 1, 2, 3 bars down. We then enter this slight congestion period. The next run down goes 1, 2, and then 3 bars is the reversal. Then we move up. This one here gives us 1 bar, 2 bars, and then 3 bars down. And then we move up from there. Now, as long as the trend is up, these reversals down will generally last. Again, I'm just going to repeat it. I'm going to make you guess soon, but 3 days, 3 weeks, 3 months, 3 years, etc. We got to be watching on the way down, though, that the reversals up then start to last 3 days, 3 weeks, 3 months. And that's how you know that the trend has silently changed. All right, so we progress this forward. We go into this period here. On the weekly, this is October 24th, so that's in here. We can see there's quite a steep sell-off, a lot of panic selling, goes under moving averages, everyone's scared. We look at the weekly bar and we see we've got 1, 2, and then 3 weeks on the reversal. Okay, cool. We come out of that and we see we've got 1, 2, and then 3 weeks on the reversal. Okay, cool. We come out of that. Now this is the April 2025 massacre. Okay, this is the longward down trend. Now this kind of broke a lot of the rules. If we do a time measure from high to low, we're looking around 60 days. Okay, so we know 60 days is not 3 months. It actually says 1 month, but 2 months is what we'll be looking at. Okay, 2 months. And I guess depends how you follow Gann. I like to wait for that third. But Gann would say the market's going to trade down for 2 months and then on the third reverse. I generally would expect the market to reverse on the 3rd month. But either way, we can see that it still respects the same authority. We still count out. So, okay, we go past 3 days. Okay, so the market just keeps falling lower. Okay, so then we change this one to 3 weeks. Sorry, 3 weeks. Okay, week 1, week 2, week 3. Let's go down here. Let's attach it to bar. Just going to draw the bar. And we can see that after the 3rd week, the market actually, in the 4th week, so 3 weeks of falling prices, on the 4th week, the market advanced higher. Okay, so the market bottomed out here. Let's take it back a little bit. Bottomed out here, and then started to advance higher after the 3 weeks. But the sustained selling wasn't over yet. It then moved out even further, falling for another 12 days, or in weeks, 1 week. So it spent 1 more week going lower. It was about 3 weeks until this market found some strength and broke the eventual top on the 4th week. It kind of gives you some, I guess, lets you be a little bit more calm when you're actually analyzing the market. Now you want to be looking for where to buy on the way up. Okay, so all you got to do is you got to count 1, 2, 3. You can see that this came down and then broke out on the 4th bar. Okay, so this would be a good area to resume buying in. This one up here, a little bit more prolonged. Let's take a look at the time measure. This is 11 days, so it sits within rule 2. So it's either 1 to 3 or 5 to 5 to 10 or 5 to 9. That's fine, not a problem. That kind of satisfies the rules. If we look at that time period, so this is June 2025. That's just in here. So 1 bar, 2 bar, 3 bar, and then we'll be waiting for a break either higher or lower. Simply put, the break occurred higher. Okay, so we advance forward. We see this congestion in here. Okay, looks like a bit of an ugly pattern there where we're kind of getting high, low, higher, high. So this is a HH. And then we actually got a lower low. So this is an LL. Pretty scary, huh? Especially if you were doing any form of technical analysis. But it still kind of fits within the rules of that time range. There's nothing really out of the ordinary here. We just make sure that we're waiting and we count the 2 bars, the 3 to 5 or the 7 to 10, let's just call it 7 to 10, and then go from there. Each reaction down is a place to be buying. 1, 2, 3. So 3 is the break. Simple. I could show you this over and over again, and eventually, maybe eventually you'll finally see it if you haven't already. But the point is that it's just going to occur over and over again. The market's going to move in these groups of 3. This one is groups of 3 down, then 1 up, groups of 3 down, 1 up. This one here we had 3 to the upside. Then this one here was quite a long one, so let's take a look at this. This high here to this low was that 10-day rule, not a problem, that still satisfies. And then if we do a draw to bar, we bring this out, 30 days, that's 1 month. So not really anything there that we can use for a 3-week rule. I don't think that was 3 weeks, it was 4 weeks. 1, 2, 3, 4. 4 weeks down, then the reversal. But really important, once you get these sustained rallies down, so 1, 2, 3, basically, and then 4, basically once we get any confirmed reversal, it generally provides us a good buying opportunity. And that's what I'm trying to get at. Now you got to make sure that this works on the particular market you're looking at. This is just Gann's theory I'm showing you. So in this case, we have 1, then we would count 2, and then we would count 3, and we'd be waiting for a reversal. If it lasts longer than 3, we wouldn't be buying. Okay. Now, ideally, we get a reversal on some sort of technical level. As you can see here, kind of a double bottom sort of thing. It depends how much you really want to get into it all. You could do support becomes resistance, that sort of stuff. You find your own ways to do it technical-wise to make sure that you're getting those flips. However, this right now, so for the XAO, in the way that it's looking, doesn't give us any reason to believe that we're not going to get another 1 or 2 bars down. That's the way we look at it. All right, so let's transition to the Dow Jones. Now, again, I'm going to show you the exact same thing, but on a different market. It's not unique to any market, okay? And maybe I'll do the 3-month. We'll see if we can find anything on the monthly and the weekly. Okay. How are we going to find something here? We need to, let's try and find if we can do it on in here. It's quite choppy. I'll do the COVID. We'll do 2008, 2009. That sounds good. All right. Start the obvious. Make sure that we understand what the trend we're in. Oh, that was the wrong one. I'm just going to change this one to 20. And I'll just make it black. Now, the reason why I'm doing this is just so that we can eyeball the direction of the trend so that when we get any reversal, we're understanding which way we should be going. In this case, we'd be bullish until this really flips here. But we know that's towards the end of the move, so it's not really helpful in that case. But then in this instance, if the trend is down and the market's rallying higher, we really wouldn't be buying it until we get above it. So this is around 2010 is when we would start to look into it again. All depends on how sensitive your moving average is. You could have a shorter moving average, something that you're looking at. Might be a 10-day moving average or 5-day moving average. This is just set to 20. There's obviously longer ones too. Right, so we got the weekly chart and the monthly chart. And all we're going to do is count the rallies. So note that we have the downward trend here. So we're not going to be counting the moves down. Instead, we really focus on the moves up. Okay, so the counter trends to the up move. So the trend is down in this instance. The market has bottomed, it's moving up. Okay. The market moves up just 1 bar. That's it. And then it resumes down. This time we have 1, 2 bars, then resumes down. Then 1, 2, 3, 4, 5, 6, 7 bars to the upside and then down. Okay, so we can see 7 weeks. Okay, now we take a look at this here. If we look at it from this perspective, we have 0, 1, 2, 3, and then the 4th week from the low. Let's go ahead and use a time measure. 102 days. Months, 3 months. So it's just over, so it's between 3 to 4 months. But still, again, the reversal to the upside lasted around 3 months. A lot of people go, oh, it wasn't exactly 90 days or it wasn't exactly 90 trading days. So I'm just going to write this off. Don't try to overcomplicate this model. Just try to use it to your advantage. Now this one here, we can see that we have a time measure from around here to up here of 22 days. We take that to weeks and we get 3 weeks. So 1, 2, 3 up. Okay. Again, it's the third week until the fourth week rolls over. And the fourth week activates at the end of the week. So this period here is the third week, basically, according to the software, despite us seeing different. But we moved up that 3-week period into the top, and then you would be watching which way is it going to break. Does it break higher or does it break lower? That's how you count your patterns. That's how you count your bars. Again, you could do the same thing here. You get one up and then you really stagger. You don't really get anything, so you're stuck in this range. And then you move up and you finally activate the next top, which comes 3 months later. And then this is your range. Once you get the break, once you know which way the market's going, from the highest high. So if it moves up to the highest high and then moves down for 3 days or 4 days or 5 days and doesn't actually break it again to the upside, then that highest high is the latest or the most recent highest high that you use. Okay, so then the market continues to fall lower, and we'll just take a look at this one now from a time measure perspective, just to see if there's anything here. 197 days, which equals 6 months, or 28 weeks. So it's actually interesting, this one, because this one is, depending on how we look at it, we might remember that Gann told us that there's 30 minutes, okay, 30 minutes, 3 days, 3 months, 3 years, okay? Now you'll notice how the 30 kind of doesn't make sense. We got 30 minutes. So would it be 30 days, 30 months, 30 weeks, 30 years? Well, I'll leave that for you to decide, but there is some truth to that, okay? So once we've passed all major milestones and we're breaking out of key points, which is our 3s, then we can look to 30s. And there's no saying that you couldn't go to 300s and 3000s. All we're doing is just adding on a 0 or moving the decimals, so to speak. Same sort of model, same sort of theory. We're still using 3. Okay, so that wraps that one up, and then we resume our uptrend. And then once we're in the uptrend, we go, okay, so this is just a 1-week reaction, no problem. This one here, oh my God, it's falling lower. And what does it do? Well, it falls lower for 3 weeks, and the 4th week, the trend resumes. This one comes down for 1, and then advances for 1, and then comes down for 1, 2, on the 3rd bar, reverses. Perfect, fantastic, easy. This one, 1, 2, 3, by the 4th bar, it broke out. And we kind of have equal highs here, so 1, 2, 3, on the 4th bar, it broke out. Cool. Again, you're going to see this repeat happening over and over again, and this is the monthly chart, by the way. So 1, 2, 3, and on the 4th bar, it broke out. Standard models, then 1, 2, 3, 4th bar reversal, 1, 2, 3, 4th bar reversal. This one, 1, 2, 3, 4th bar did reverse. This one here, we got an outside bar, so this one is considered a 1, 2, 3, where the outside bar creates both a high and a low for the movement. This one here, we got 1, 2, and 3rd was the reversal. 4th bar continued higher. We moved above the moving average again. All right, so let's go forward to the future. This was the most recent one. Okay, so this is the high. 1, 2, 3, 4. Depending on how you look at this on the weekly, let's go to the weekly. That is April 25, I believe. So we had the breakdown, then the movement up, which is this bar here, and then the breakdown, the movement up, and the breakdown. So it's kind of 3 movements here on the weekly chart. First time measure comes from this one here, comes down. We're looking at 23 days. We changed that to weeks. We're looking at 3 weeks. This one here, before the movement up, so the outside bar created the high and the low. We're looking at 3 weeks. And from here to here, this is the last move down, actually. So really the low came in here. So 1, 2, 3, 4. On the 5th bar, it kind of started to reverse. All right, I think that wraps up what we're looking at for the Dow Jones. If we take a look at the daily chart for the Dow Jones, and we do the same sort of model, we can see here that we're kind of staggering at highs here. So we really have, depending on how we want to draw the pattern, there's multiple different ways people like to look at things. Basically, we want to know what our ranges are. Okay, so right now we have the tops here, which are not breaking. And then we want to count. So we wouldn't be selling here because we got 1 down, we got 2 down, and we might be expecting a 3rd day down before a reversal. Okay, something to think about. Let's go to the weekly chart. Weekly chart's a little different. We need to be watching things a little bit differently. So we do have a lot of, I need to get these exact highs to find out which one's the highest. This high is 633, so 49,633. This is 49,621. So 633 is currently the highest. And this is 653. So this is the highest bar. All right, so from a weekly perspective, we've just made a high bar. We haven't got week 1 down, week 2 down, or week 3 down yet. So we'll keep that in mind, that we may be expecting a bit of a rollover. We may be, and it could last. If the 3-day chart doesn't reverse it, then it could last 3 weeks. Okay. And that would then take you out to March. So time measure out, 21 days roughly. That would take you out to end of February, March. That's how that works. Okay, so we're going to move on now to Bitcoin. If you've been waiting for Bitcoin, this is going to be for you. But this is what we're looking at. So again, same thing. We'll clone the chart. And you got the thing is that you have to do these exercises. Okay, you have to do them. I can show you as many examples as I can, but until you do the exercises yourself, all I'm showing you is just really going to be wasted air. You got to get down the chart, or get to the chart that you're looking at, and see if this works on that specific chart. It might not. Okay, I'm not saying it's guaranteed to work. You got to prove it to yourself if it does or not. So left-hand side, we got the daily chart, and right-hand side, we got the weekly chart. Let's go back to this low here in 2025. That is this one here, April. And we're going to be counting the down bars because at the moment we are in an uptrend. Okay, so we see the trend line is up. So anything we count is going to be to the downside. Over here, we flip that. Okay, we see that the trend line is down. So anything we count is to the upside. Let's begin taking a look at the daily and weekly. That's this trend actions in here. So from a daily perspective, we can definitely see that this rule still applies. So we have 1, 2, 3, and then by a 4th, 5th day, on the 6th day, it broke out. So we'd be mapping our little location on the chart, making sure that we're within range and just counting 1, 2, 3. If you really wanted to buy on the 3rd day, the most probable likely bar to be reversing the market is the 3rd day bar. Okay, so we got our high, we got our low, and we want to count 1, 2, 3. Doesn't really break the 3rd day here. So we got a high, we got a low, and we want to be counting 1, 2, 3, and then the 4th day breaks higher. Same thing. Okay, so we got a high and we got a low, and we want to be counting. This one here is actually bar 1 in this case because there's just the high and the low. Then 2, then 3. The 4th bar tried to come down and break it, never did break it. This zone in here would have been an opportunistic point to buy in. Okay, so we can see that here the flatlining of the moving average is going to change, which means that possibly we should be looking no longer at the daily bar and moving into the weekly bar. Either way, 1, 2, 3, and we have a bit of a trend, but it doesn't break the highs. Instead, it breaks lower. Not helpful at all. 1, 2, 3 breaks lower. Then on the 5th day, we get that reversal. This would be the range that we'd be looking at. However, we can see that from our 3-day reversal up here. So 1, 2, 3, market breaks down for 3 days, moves up for 1, 2, 3, 4 days. So just outside the 3-day rule, moves down for 4 days, just outside the 3-day rule, moves up for 4 days, or 3 days if we don't count the high here. So moves up for 3 days, then moves down for 3 days, then moves up for 2, then moves down for 3 if we count the outside bar here. Okay, so we're getting this 3, 3, 3, 3, 3 swing. We take a look at the weekly chart, and we can see now, obviously, we have these ranges here. Market moves down 1, 2, 3 days, or 3 bars. Market moves down 1, 2, 3 bars. Market moves down 1 bar. So again, we've satisfied the rule multiple times if you were really looking to buy on a weekly. 3 bars down, especially when the trend is up. The trend has to be up for this to be actioned. Buy on third, moving down for 1 bar, so you couldn't count an entry. But this generally, like if you had just followed this rule only, this would have given you a lot of excitement and you probably would have been extremely bullish. But we can see that it did reverse straight away. So we do have to follow or know other models and theories or technical analysis, price analysis, etc., to understand when we're likely to get out of the stock market, okay? Or the cryptocurrency in this market, in this case. So we can see that this market is now heading down. In this instance, we're not going to be counting anymore the moves down. We want to be counting the moves up because the trend is down. So any move up is going to be counter trend until this starts to move up. Okay, so all these moves away from the trend are just counter trend trades. So we have 1 bar, 2 bar, 3 bar. Again, this was our last high, and that's why we count down 3. Market starts to move up. Trend now reverses, goes down. Okay, so now we want to be counting up. 1, 2, 3. Market falls. 1, 2, 3, 4. Okay, just outside the 3. Depending if we count the inside bar or the moves higher. 1, 2, 3. Okay, there are 2 ways we can look at this now. And it all depends on where we are in the long-term trend. Do we switch it to the yearly or the monthly? Is the yearly or the monthly still pointing higher or lower? If the monthly is still pointing higher, then we really want to be watching our 3rd bar or 5th bar down. So in this case, we'd be looking at 1 bar down because we have the outside bar, 2, 3, 4, and 5. If it passes this, then we'll be definitely going for that 7 to 10 time range. Obviously, that's markets moving down. If we believe that we are still in a, let's change this one. If we believe that we're in a monthly uptrend, okay, we turn on the weekly and we look for the reversal on the weekly. So in this instance, we have 1, 2, 3 bars. Does it go out on the weekly 4 and 5, or do we get a 4th bar reversal or a 5th bar reversal? Again, all depends on the trend. Right now, we can see the daily is down, the weekly is down, so the trend is bearish, definitely bearish. But we're starting to roll over on the monthly. At least this moving average. The moving average could be anything that you want, whatever special number that you use. I'm using 20 just because it's relatively fair right now for what we're doing. I'm going to close that up now and show you now the final market. Again, any market, any time frame, we can take a look at this. On the left, we're going to do daily. On the right, we're going to do weekly. I'll pop on just a standard moving average, 20 again. Exactly the same as last time so that there's no difference here for you. We can see that we are definitely still, we're below the moving average, but the moving average is still pointing higher. For the weekly moving average, we're still pointing higher, so we would be counting the bars down. Now, I'm not going to bore you with this whole process because I think you're getting the idea now that's what's possible and how we do it. 1, 2, 3, reversal. 1, 2, 3rd bar reversal. Okay, cool. That's fantastic. Okay. We can also see that we also have possibly a longer sideways trend here. So when is this? This is November 25 to December 25. That is this period here on the weekly, so it's not very helpful. But let's go back a little further and see what happened here. We have 4381 as the high and 4379. So this is technically the high here. Bar 0, bar 1, bar 2, bar 3. We would really be blocking out these zones here and really trading a break if we were to follow what Gann was telling us. However, you could go down to the smaller term time charts and just really have your stop losses, whichever direction you're betting on these highs and lows of this range, and then trade the breakout. We have 1, 2, 3, okay, and the fourth bar moves higher. You can see that. This one here, we have 1, 2, third bar breakout. Doesn't last very long, does it? Now, this is actually a quite steep sell-off. We have 1, 2, 3, fourth bar reversal. Then we have 2 bars up, signaling weakness in the trend. And what do I mean by weakness in the trend? Well, if we have previously been moving up 1, 2, 3 weeks, 4 weeks at a time, or 1, 2, 3, 4, 5, 6, 7 weeks at a time, and now we're only advancing 2 weeks at a time, 2 days at a time, I should say. It all is all the same though, 2 weeks, 2 days, 2 years, 2 months. We're looking now at what we call time and price over balance. And in this case, it's underbalancing. What this is saying is that there is still structural weakness, okay? We go back and we go for where the zones where the market was weak. Hey, we had 1 day up, 1 day up. Here we had 1 day up. We had 1 day up, 1 day up, 1, 2, 3, 4, 5, 6 days up here. But we would be counting the bars essentially, just like this. And we'd try to get an understanding of where are we now and what has happened in the past. This would signal our weakness. Anyway, so then we have 1 bar down, 2 bar down. Now, we're going to get a third bar reversal, or we're going to get a third bar low. Well, that would be interesting to see what actually happens, I guess, tomorrow over the next 24 hours or so. But there is a chance now that there is definitely a chance that we reverse for 1 more bar and create a new low before reversing higher. Now, we have to be following the trend. So our reversals that we're looking at are to the downside. Okay, so we're looking for those counter trend reversals. Until this swings down, we need to be counting the bars moving down. Same for this one on the weekly bias. Okay, we got 1 bar, 2 bar, 3 bars as the breakout. This is just 1 week. So we're really betting on now the gold market to push higher from here. Because if it doesn't push higher from here on the daily, it then threatens the weekly. And the weekly actually needs to make its way up here or get stuck in some sort of range. Okay, where it really just gets stuck in a range and makes 3 down, 4 up, 4 down, etc. Else we really are threatening a break here if we don't get that change of trend. I'm not sure if that really makes sense, but you can see every other time we really pushed for that breakout. We really pushed for that breakout. But we look how far away it is on the weekly compared to the past. And this is quite far away. It's going to need some time to get back up there, and that's going to require a lot of energy, a lot of volume, and also time. So I think that from here we might go into some sort of sideways trend before we move out from here. But the same rule applies. Trade your dailies and trade your weeklies. Look, I'm not sure if that was helpful to you at all. My aim was to really explain and show to you Gann's rule of 3 method in a way that was, I'm hoping, practical. This is not a study lesson at all, in the sense that you're not going to be sitting an assignment or doing a test or anything. But apart from what you read on the internet, I don't think anyone has really showed you this, unless you discovered it yourself. But I don't think anyone has really showed you this just in the way that I have, with some extra tips along the way, which I'm hoping may not be visible right now, but hopefully beneficial to you in the future as you continue to study Gann. Now, always remember, you can come to the School of Forecasting. So the International School of Forecasting is what it's called. If you'd like to study Gann, we do all sorts of time stuff. We generally focus on the time element of the market and not the price element of the market. And that's because everyone focuses on price. So we had to try and find a way that we could be different. So I decided to stick price to the side and just focus on time. And that's why I spend a lot of my time, I guess I'm got no better words now, but spending a lot of my time focusing on the time element of the market. So yes, I hope that has been helpful to you. And if at all or at any point in time you'd like to join us, you're more than welcome to. There's links all over the social media profiles, all over YouTube. You can just click one to join any course that you find is going to benefit you. I'll see you next week.